Inflation is rearing its head again in the U.S. as headline CPI returns to 5.4%, the highest level since 13 years ago. We're here to discuss inflation hedges and the macro outlook with Ted Oakley. He is a founder and partner of Oxbow Advisors. Ted, welcome back to the show.
Thank you, David. Glad to be here.
Glad to have you as always. Today, this morning at 8:30, we had the newest CPI numbers, 5.4%. So back at it again. We've had 5.4% several times again this year. It dropped slightly to 5.3 last month. It's climbed back. Now, I was just thinking, Ted, so this is just a thought of mine, and I'll like to get your thoughts. If the U.S. dollar is depreciating vis-a-vis the consumer price, because that's what inflation really means, it means erosion of purchasing power and wealth, why not invest in non-U.S. dollar denominated assets? Why not move all your portfolio to another currency, to another country, or perhaps even considering, if you want to consider cryptocurrencies an alternative currency? I mean, that people have been buying houses. I talked to somebody recently. He said, I sold my house, and the guy, he bought a house and he purchased it with Bitcoin. So the other guy got a much better deal because his house didn't appreciate by 8 times over the last year. So it just got me thinking, maybe we should be buying things in a currency that doesn't depreciate by 5% a year. What do you think?
Well, David, I think what will have people will eventually figure out is that your cryptocurrency is not, just because it's gone from 20,000 to 57 or whatever, doesn't mean, I also see these 50% drops in it and that sort of thing, very rapid. And I don't think there's ever going to be a currency like that that's going to replace the central banking currencies. However, I think they will come with a digital currency that is stable, and that's going to pull away from the others. To me, a lot of the cryptocurrencies, there's 6,000 of them. That's just a big fad, particularly with young people. I think they'll lose a lot of money eventually, but some of them will make it. On the side, what you're talking about here is that we have found, and we've tried it before, but when we hedge out on owning, for example, dollars, owning euros or yen, or something along that line, we never really made a lot of money like that. We found it better for us to have a gold position. If your rates keep going negative, real rates keep going, moving forward like that, then gold is going to do pretty well. So that's kind of how we hedge it. I don't know how other people do it, but that's what we do.
Okay. Now, I've heard one school of thought, which is that buying equities in itself is a hedge against inflation because businesses by nature are inflation hedges. You run a business, you would think to raise your prices to keep your margins high. So what do you think?
Well, this is true. We have a study that shows when rates are low and going higher, high and going higher and going higher, and then higher and going lower, and then lower and going lower. And what happens in all categories of those? Actually, it sounds strange, but you get into all 3 or 4 categories of inflation, depending on where you are in the cycle. Stocks do fairly well relative. They're relative to other things. The others, if you look at real estate, even gold, different things, they will get, energy particularly will get hurt in some of those situations. But stocks, they have different levels, but they do fairly well in all of those things because you have to think about it like this. If you're going to stay in business, you'll have to raise the price or you'll go out of business. And that's really where it comes down to.
That's right. Well, let me just ask you, do you think businesses, small and large, do you think they will be successful in beating inflation this time around? Do you think margins can be maintained?
I don't think they'll be successful this time. If you notice, of course, of just the few Fed governors we have left, they started toning down. You don't hear them say transitory as much. In fact, there's a couple of them now using largely transitory, which is a kind of 2 steps backwards. And I think what happens is they'd like to do it that way, but I think the marketplace will override that. And when it does, between that and fiscal policy, that's where it's going to happen. And so I think, you could probably have it come, but for us, we think, at least to go back, the only thing could happen here is if you roll into a recession because we're not really coming out very hard, well, yeah, they can start buying everything again, but, they've never quit yet. So we'll just have to see how it pans out. I think people have to be real nimble here, though. Watch your long bonds. We don't own many long bonds, really, and watch what you own in the short term as well.
Mm-hmm. How would you define an inflation hedge? Is it something that just grows at 5.4% CAGR? What would that asset be even?
Well, here's one of the problems with it, Dave, is you never know. There's different things. For example, in my own personal business, I've had commodity accounts for years, and I don't run them. These people run them for me out of Memphis. But for example, the one is a cattle account. The cattle account is up probably 40% this year.
Wow.
And then you'll see something else that's not as much. We think you have to have a mix. We think you have to have a mix of agriculture, food, energy, anything that's tied to making hard things, okay, materials. And real estate's a good hedge too. Unfortunately, it's starting off at a really high level. So you can't price it from a cash flow standpoint. You're having to, right now, you're having to replace real estate at replacement cost. That's the only thing it's selling on. But there's, what you do is you own a whole mixture of things, because one of them is going to be working when the other one's not. But over time, over a 10-year period, they'll all go together.
That's right. Now I'm going to go back to the house selling example, and these are anecdotes I hear from my personal life as well, from my friends and family and whatnot. So they sell a house, right? They sell a house for, let's say, $500,000. That
Right.
immediately, that $500,000 in today's environment is going to depreciate by at least 5% a year. So they've got to do something with that cash right away, where they're going to start losing value just putting it in a bank account, because I don't know any high savings interest account that pays more than 5% right now. If you know, please let me know. So what do they do, Ted? What do they do? So you mentioned a few assets they could buy into already. Some of these products are a little bit difficult for the retail investor, right? Like agriculture, you gotta buy some farming stocks or commodities.
Well, that's a good question, David. I think here's what we do, and I'll just kind of pitch it out there. Some things that we do. I think we do not own indexes or exchange traded funds. We own the single investments, okay? But on that count, what we've done with people that had a liquidity event, okay, and let's say they don't want to take the whole 500, they'll use your example and put it right back in. What we've done is say, look, we're only getting, most money market funds are paying one basis point or two, but not much money. And so we're saying, we need to get that number up to where it's probably at least we'll run about 65, 70% liquid in the treasury. We use a floating rate treasury. And then the other portion of it, we're putting in some things like we have a number of too big to fail bank preferreds that are they're not in call range, so they can't take them away from you. And we have some convertibles. So what happens on that, we try to get that yield on that money up for the time being. On the short term, they'll have to take a little bit of a hickey, because I can't get it up to 4 or 5 without taking. I mean, even the high yield bond index is not paying that. So the only place we get that is in our aggressive income account. We're widespread. We get very high interest rates on our energy. We get very high interest rates on our. We have 4 medical real estate investment trusts. We get really great yields and returns on our convertible preferreds, but that's how we hedge it. But in that same portfolio, we have fertilizer, we have timber, we have gold, and we have a number of things that in addition to having cash flow, it offsets the inflationary side.
Okay. So you've mentioned a number of different asset classes now. Asset allocation, what is the percentage of allocation you would designate to each of those assets you mentioned?
For us, a lot of our people over the years sold businesses, and so they had a one-time sort of meteor liquid effect, and they're not going back to work. And so they usually spread in all of our strategies. They'll have some over here that's bulletproof practically. They don't make a lot of money on it, but we always feel like people should have that. All right, that's what we call sleeping money. And then the other 2 are in our aggressive income account, and then a full stock account. And our stock accounts, we're running about 23% liquid. But if you'll look at basically what we're emphasizing over there, okay, we're emphasizing the things that we think can grow even in a downturn. And these are companies that can't have much debt, have a lot of cash, and a lot of them you're aware of, but it's basically digital advertising, the big three there, of basically Google, Facebook, Amazon. Then the cloud is a big place we are. And, we're in the payments business. If you look at Visa, MasterCard, PayPal, and then we fill in with a lot of things that you have to have during those periods. O'Reilly Automotive, Salesforce. You look at United Health. There's a whole mixture. That's in the stock account now. In the income side of that account, and this is where we get a lot of our inflation hedges too, we own about 22 or 3% energy. I wouldn't be surprised for it to come back a little bit right here, just because of how far it's run. We've owned it, since last year. But I do believe that next year, oil and natural gas are going to go higher than they are right now. And I think we've got a winter coming, and I think it's that situation. We also, if we can buy a real estate investment trust that's solid, they'll give us, 6% or 7%. We like that. We like those preferreds I mentioned. We like I say, we like fertilizer. We like timber.
Sure.
All of those are companies we own, but they all pay decent dividends. They're all up there at 4 or 5. We have one refiner, Valero, and it's about a 5% dividend. We've owned that though since for quite some time, and I don't know that we'd be buying a lot more of it here, but that's how we spread it. And then we have gold, and 2 out of the 3 portfolios have gold and gold miners.
Sure.
And I know people are sort of giving up on gold because it just hangs here, it's 1750 or so, but in the long run, as long as you have real rates going that negative, somewhere along the line, other governments are going to say, I'm going to pull my dollars. I'd rather own gold because what's happening to me is I'm losing money on that.
Sure.
And I won't be losing money on the gold. I don't think they'll go to crypto. Some of them may, but not. I think more go to gold.
Well, let's talk about real rates. You're absolutely right, Ted. I mean, there's a very good, strong correlation between real rates and the price of gold. Now, real rates already are negative. I think what would affect the gold price now is if real rates go even more negative. So the delta, so to speak, the change of real rates would affect the price of gold. So do you think that there is a possibility that real rates could go further into negative territory? We already know that nominal rates are near zero. So the only other variable in this equation is inflation. For real rates to be even more negative than they are today, nominal minus the inflation rate, the inflation has to go much higher. So do you think inflation can go much higher from even 5.4%, thus driving down the real rate?
I think they'll let it, David. I think they have to I think they think this will breeze over, and it probably will to an extent, but I would guess you would still hang at 33.5 or 4, which is a lot more than we've had, for a long time. It's double what we've had for the last 10 years. So I think what would throw people is that continued to be that way. And so, yes, I think that could still happen here. And what the Fed would do is much like 1944 to 1980, they let the inflation run just a little more than what you could get on interest. So you were continually losing ground. You didn't know it because it felt like you were making more money because it inflated. But in fact, you didn't, because your earnings were less than the inflated number. So sure. What I think is happening, we started at 44 at 110% of GDP, debt to GDP. We're about there now. It took us from 44 to 1980 to get back to 30% debt to GDP. Not because we paid the money off, just because we ran the numbers higher in inflation, which made the GDP go up. And so you see how it works. And they kept the rate, the nominals lower. And so that's the way we see they go out on this one. I can't give the levels. Maybe it's 5, 6, 4.5. But I could almost promise you that inflation rate will be more than what you can get in interest.
Okay. Oh, well, that's tough to swallow for a lot of bond investors, for sure, Ted.
If you look at this, though, almost every bond fund is down this year, and people still believe in bonds. I mean, this 60-40 idea, which is it's everywhere amongst these financial planners and that sort of thing. It's just do the 60-40. Well, it's been great for the last 8 or 10 years, but it's up. There is no 40. You've got 1% interest rates. So
Yeah.
you better find something else to replace the 40 is what I'm saying.
Well, you mentioned a few of your fixed income proxies. So those are all the alternatives we can look out for. I'm curious to wonder as to whether or not Biden's increase in capital gains taxes this year have impacted your decision to allocate assets at all.
It hasn't, not for us. It has for the private companies I'm involved with, though. Well, what happens when I say that, I'm part of businesses and banks and different things personally. But on the investor side, it hasn't affected us as much because the reason we're running that cash number is not because we are trying to time the market or something like that, but we have fairly strict parameters on what we want to pay for something and know where we want to be in it, and everything is above that point. And so that's sort of where we are. Not so much in the high income account. We still have quite a few buys over there, but in the growth stock account, they're fully priced. We like them all, but when we get new money in over there, we keep it at about 50% cash for a while.
Well, if an administration is signaling or has straight up announced that they're increasing taxes, would you not take profits before that happens?
Well, everybody right now, we found, I just finished my market letter we just sent out this week, the quarterly, is entitled On Edge. And the reason it is because all of these private companies and individuals are really on edge about what to do. Some of them have assets they need to sell. They want to start up new things. They've got one going from this over here and going to another. And even if it's 28%, that's been thrown out, 26 has been thrown out, 31's been thrown out, it's probably not 40. But even if you take 26 or 28, then you add a state tax, which is, most of the states, on top of it, you're still knocking 30%. And I think a lot of transactions in real estate and particularly in private companies will be put on hold because they'll look at that and say, I can make that money back in 5 years. I have noticed I haven't seen anything, and I'm not a technician on this for sure, but I haven't seen anything in the bill that is going to get rid of 1031 exchange. That would be a blow to the real estate business. And I haven't seen it. Probably somebody out there could enlighten me if it has been put in there, because if it gets put back in, that is a huge blow to the commercial real estate business.
Okay. Finally, I want to touch on global growth. The IMF has recently downgraded its global growth forecast slightly, not by much, but they've downgraded it by about 0.1% from 6% to 5.9% for the following year. Now, assuming they're right in that global growth will slow down slightly, is this going to have any material impacts on the global financial markets?
Well, I'll tell you, David, I don't think anybody listens to the IMF. I think the IMF is in effect, other than loaning money.
I will add, though, that their downgrade comes after some financial institutions have made similar downgrades. Goldman Sachs, for example.
David, you took the words out of my mouth. I was going to say, you're really late to the party here. Okay, and they were talking, if you looked at that announcement, they slammed the Fed. They said, because see, our inflation rate's higher than Europe. And so they slammed the Fed by saying, you're not being, and if you had to read code, they said, hey, you're not being honest because you're saying you're going to pull off bond buying, going to do this, going to do that. We want you to be more clear. In fact, they even came out and said, we want you to be very clear on what you're going to do. And I'm thinking, well, good luck on that one. That's about a 50-year run there. That hasn't happened. And so they're very late, but I would doubt seriously if any portfolio manager even noticed it, honestly.
Okay. Well, forget their forecast, but what about the actual effect of a slowdown? I mean, suppose the IMF said nothing, the economy just slows down by itself. Yeah. Is that of material interest to a fund manager like yourself?
It is. I mean, if you take, for example, the university, there's not a lot of these things matter, but if you take the University of Michigan consumer sentiment, it's down 11%, back down to where it was, 3 months ago. That's not a 100% indicator, but it's about 75%. And it's usually something that tells you that the economy is is slowing down. You may not see it because it still feels like bang, bang, bang.
Right.
But in that measure, it's like that. And then if you go look at the National Federation of Independent Businesses, they're saying the same thing. Now they're raising their prices. They have to, but they're all saying at the same time
Sure.
they think business is going to be lighter.
Sure. I've also read a study in the past about the direct correlation between housing prices and consumer spending. I think the logic here is that on paper, people think they're wealthier if their home prices continue to appreciate. So let's follow that logic, that train of thought. Assuming that study is, logically sound, one would think that consumer spending would continue to be strong in an inflationary environment if, let's say, residential housing continues to do well. Would it not?
It would, but it depends on where you're starting from. Like I own part of a bank, and so I'll give you an example. We do more refi, a lot more refi now than you do on purchase mortgages, because everybody's realizing, hey, I've got this new price, and that gives you some juice for a while because a lot of people are putting on the refi right now. One of the problems you get into is this, though, David. When you get a price that increased 23% in a year, and let's say you're going to put on another 6 or 8 or 10 in the next 12 months, I don't know, but something. And people have already refied, or they sold a cheaper house and bought a more expensive house. They're in at a high price. And then let's say you get a breakdown in the housing market, and which you always do. People that tell you that is they don't watch things. We got a major correction after 06 and 07 in home prices versus inflation. So if you get that then, and they've already locked up in this real high level, just think about it, because we have a lot of movement in the U.S., companies moving various things. You've got to go to the marketplace and sell that house, but it's probably going to be down to your mortgage level, you see? Now you got trouble in paradise because somebody else has got to buy it. And that's how things get started in the wrong direction. And what'll come, I do think housing will do okay over the years, but here's how it's going to go, in our opinion. They will take the lot size down. It's all about payment, believe me. They'll take the lot size down and the home size, which is in the 3,000s now, they'll bring it down in the 2,000s, and it will be the price you can write a check for every month. And that's the key to building.
Okay, good take. And last question before I let you go. S&P 500, putting all this together, slightly lower growth, slightly higher inflation. What do you think the S&P 500 is going to end up or down by, let's say, next year?
Well, I think this year is sort of in the bag unless something real unusual. You don't normally have a lot of break in the fourth quarter. If you go back and look at markets, whatever, and we've done studies on this too, that if you've gotten 20% or so in the first 7 or 8 months of the year, you don't usually get much more than that. Maybe a little bit, but not a lot. But when you get into next year, it's a different story. I think between what's going to come out of Washington and what the Fed is doing, and just face it, they're going to put a lot more doves on there. It's going to just blow the whole thing up more. And by the time you get into 22, it's hard for us not to see that in one of those first 3 quarters, you'll have a fairly significant drawdown. I'm talking about 15, 20 points. I'm not talking about killing the world here. I'm just saying we're overdue that, and that's what we would expect.
All right. Excellent. Ted, you're a wealth of knowledge as always. Thank you so much for coming on the show today. Appreciate your thoughts.
Thank you, David.
Thank you for watching Kitco News. I'm David Lin. Stay tuned for more.